trust your crypto assets to centralized exchanges that actively sell your private information and front-run your trades? Would you like to buy and sell your assets without any middlemen, intermediaries, or robots? Do you like paying slippage, fees, and having the price go up as bots steal from you on low-liquidity decentralized exchanges? The solution is nodemarket.io. Set your guaranteed buy or sell price. No middlemen, no slippage, no bots, ever. Buy or sell 1, 10, or even 10 million tokens, and you never have to worry. OTC trades are between you and the seller or buyer, guaranteed by audited smart contracts and no human middlemen. Nodemarket.io.
All right. Let's see. There we go. Who do we got? Well, there's the email, by the way. For anybody that wants to email, let me rephrase that. If you must email, not anybody who wants to. This isn't a fun, happy, good times email chain line. This is if you have a technical issue and you can't solve it. All right. Hello. 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 Hello again. Hello. We're going to get them all. Every one of them. Every last one. Bam. No, because we weren't getting any views. I mean, I don't want to do it just to service 6 people. It was like the same. It was like a dozen people were watching each episode, so it doesn't seem like there's any point to it. I'm not really in the business of just superfluous work, just clicking buttons for the sake of clicking buttons. You know, at some point, treasures, if they should have it auto post. I don't know why that's not an automated thing, but it doesn't. You have to cut the video, repost it, do the title, all the description work. You have to do a picture, like a little stupid ass JPEG thing. It's a freaking headache. So no. Sounds like Nick and Friends. Yeah. All right. Okay. So let's go. Oh, by the way, the Leap tokens pretty much just about gone. It looks like. We're at kind of final orders. So it's, let me go back to the main page. So we're at 1184. So like it said, 47.4 million-ish gone of 50. So 94.8%. Isn't that the temperature? Isn't that right around the body temperature? Not the one in the mouth. The mouth is a little warmer, but isn't that like the normal body temperature? 94.6 or is it 96.4? I better get that right. Anyway, yeah. Oh yeah. Yeah, if there's too many curse words, I gotta nuke it from YouTube. I don't think we're gonna get a lot of curse words today. 98.6. Well, we'll be there later today, won't we? But the temperature in the mouth is different. Did you guys know that? The normal temperature in your mouth is different than the normal temperature in your body. Huh? Little factoid there for you. Will you post Tuesday's show on the website? No, I will not. Tuesday's show does not exist. because I used too many F-bombs. There were so many F-bombs. Of course my kitties are still living with me. I used too many F-bombs. When I use a lot of F-bombs, the show must go. If it was a digital investor one, that would be different. But if it's these are just the funsy Tuesdays and Thursday funsy ones. I hope Kirill is here. Is he here? Because we've been kind of back and forth, kind of mentioning credit spreads. I thought, we mention it. People talk about it. But I think even some of the people like on CNBC and stuff that are talking about it, they don't really even know what they're talking about. They're just reading crap off of a screen. So we're going to talk about credit spreads today. Oh, I did have a little update. Let me see if I can pull it up. I was talking to the guys from Libra today. They think they have a way to connect, and I won't give you any details because I think they don't want details out. They have like a retail discount voucher program, and they think they have a pool of about 3 million people that they can access. And then they're going to build an app for those consumers so they can also get rewards. All of that, again, trading the Lieb token. So that's kind of that's different than yesterday. So they're doing a lot of stuff. They're entrepreneuring. They're entrepreneuring. So that's good. Yeah. So it's good when we hear details about like that they're continuing to innovate. They're doing all sorts of cool stuff over at Twin also. It's just lawyers, man. Lawyers. Oh, yeah. Yeah, we're going to talk. We're going to mansplain credit spreads. We're going to mansplain credit spreads today. It's going to be good. Trying to get treatment for for your incontinence, Pepto-Bismol. For your sister's dementia, I don't have one for that. Ginkgo biloba, whatever. Oh yeah, I used to nuke videos all the time. People don't know. I used to at least nuke 2 videos a week. Every week, guaranteed. It was gonna be F-bomb-a-palooza. Is Libra similar to T? No. Temu is a site that pushes products. Libra they aggregate data, they monetize data, they sell data. They're a retail data aggregator and sales portal. So they basically monetize all that stuff so that other retailers can use all of that data to fine-tune their sales efforts online. That's like the easiest way to say it. Yeah. So no, they're not even at all similar. I mean, they're both companies. Arlen, they're both companies. And in that way, they're very similar because they're both companies. We think with people. All right. Worried about Harris proposed. Oh, yeah. So we'll talk about that for a second. The capital gains on unrealized, what it would be is unrealized gains tax. Does everybody understand how unrealized gains works? Let's say you bought some stock for $10 and it went to 100. You have an unrealized gain of $90. They would tax you on again. This is a proposal that's not going to go anywhere. Because remember, in politics, how many people got rich in Congress and the Senate due to, well, we know how they got rich. Let's just skip over the part that they let themselves insider trade with there's no legal hangups with that. They allow themselves to break the law and it's legal. We'll get past that. There's a lot of rich people they've made themselves rich off of cheating and stealing and theft, greed, graft, and corruption. But the fact is, they're rich. Do you think that that a bill that says we are going to take 25% of your unrealized gains you haven't booked, that thing's not going to get out of, it wouldn't even get out of committee. That is the kind of thing that a politician would say when they are catering, let's be honest, to a bunch of people that have not enough stuff. People that are having a hard time making ends meet, people that are having a hard time making money, and it is tough for people, and that is just catering directly to them and saying, hey, poor people, hey, disenfranchised, hey, unemployed, wouldn't it be great if we really stuck it to those rich people? However, it's only to people with over $100 million in assets. I don't think that's not any of us, or at least I don't know that that's any of us. Might be some of you, but it's not me. So one, it will never happen because the same people voting on it would be affected by it. Two, it will never happen because this is going to galvanize a bunch of people on the other side. They are making enemies faster because, see, this is a slippery slope. First, it's on people that make over 100 million. Then you go, 50 million, 25 million. And pretty soon, people that make over $40, unrealized gains taxes. So it will not happen. And even if it did happen, it wouldn't nuke crypto. Do you think that everyone in crypto has 100 million or more in crypto? So you got to kind of walk it back and go, this is a lot of it's her appealing to the poor woke caucus, which is fine. Ain't no problem with that. That's politicking. And it's nonsensical. And I don't know a universe where it would pass. People would start putting stuff in trust funds, pushing money, because it has to have an effective date. And whatever that effective date is, people would structure things in such a way that the government got about 4 cents out of this. It would be a colossal fail after having angered that many people. So I just don't think, there's any chance. It's just a talking point. It just makes poor people think that they're sticking it to the rich people. Yeah, pay your fair share. Like, well, they do. But anyway, whatever. Okay. Also, what up? Leaving the house. Let's see. Will they pay us on capital? Yeah, exactly. Yeah, when these politicians come up with this, it's so stupid. She's just appealing to the lowest common denominator. Ugh. Let us see. Let me make sure I didn't miss anything. Yeah, a lot of stuff at Temu is garbage, but I will say this. They have really nice, you can get good towels. You can get good towels from Temu. Yeah. Really good towels. All right. And Frank, like anyone, F-bombs are good for everybody. Everybody needs an F-bomb in their life. All right. Yeah, Temu, they're good. You have to unsubscribe from the emails, but you also have to go into the app if you use the app. I like Temu. I've got all sorts of cool stuff. I got hoses, those water hoses that extend. I've had good luck at Temu. The only thing I got that was crap is I got a water. Oh, it wasn't crap. It was weird. I like water hoses that do all sorts of weird things, because like for washing cars and all that. And I found some good home ones, but we've got some for the shop to wash cars. And the problem is, like, if a car drives over it, disintegrated. I thought they were kind of heavy duty, which they are not. So that was not a super win. But all the other stuff I've got, I liked it. Well played, Joseph. Well played. Okay. let me change up that banner because we do have some news, some crypto news. All right. A judge, a member of the judicial, he says, now we got some stuff to talk about. He says crypto tokens are not inherently securities. You may have seen this. Anyway, it's worth noting. U.S. judges clarify that crypto tokens are not inherently securities under current laws. Recent rulings stress that context does matter in classifying cryptocurrency tokens as securities. Judges reject the SEC's argument that crypto tokens themselves embody investment contracts. That's like saying that an orange embodies an investment contract. It may be used in a scheme that looks like an investment contract, but an orange is not an investment contract any more than a crypto token is. The context matters. U.S. judges are providing clarity on the legal status of crypto assets. In a series of recent rulings, judges have emphasized that tokens themselves are not inherently securities. These decisions come from cases involving Ripple, Kraken, and Binance, where the SEC sought to categorize these tokens as securities under existing laws. And Judge Torres kind of ripped that apart. In the SEC v. Ripple case, Judge Torres explicitly stated that XRP, and technically it's not Ripple's digital token. That's flawed. Technically, it's to build the ecosystem, although Ripple, the company, does use it. Matter of fact, that's the only reason they're in business, is because they have all these tokens that they created for themselves. But anyway, long story short, but the XRP token is not inherently a security. The ruling addressed the SEC's argument that XRP, this is what the SEC was saying, is that XRP, by its nature, the nature of being a token, should be classified as a security. That was a huge mistake for the SEC. Judge Torres asserted that XRP does not meet the criteria of an investment contract as defined by the Howey test. This decision underscores the need to distinguish between the token itself and the sales of the token, which may involve security laws depending on the circumstances. Ooh, which they did get found guilty of. They did violate securities laws. That's the whole thing. Everybody's like, Ripple won. Yeah. No. XRP, the token, won. Ripple, the company, lost. The executives lost. They got caught breaking the law. So whatever. In SEC v. Payward, which is Kraken, Judge Orrick reinforced this distinction. He remarked that just as orange grows in the Howey case were not securities, cryptocurrency tokens are also not securities by nature. Judge Orrick warned the SEC to be careful in making such claims. He emphasized that arguing tokens themselves are securities could not proceed under the law. This statement reinforces the idea that the context in which tokens are sold or marketed plays a critical role in determining their legal status. It's the way you market, it's the way you sell. Probably why the team at Twin is like, their lawyers are dodging and fucking, doing lawyer stuff. In another case involving Binance, Judge Jackson rejected the SEC's embodiment theory. The SEC argued the tokens themselves represent investment contracts. Judge Jackson disagreed, stating that tokens can be involved in investment contracts but aren't securities themselves. These rulings continue to stress the importance of context in applying security laws to cryptocurrency tokens. So while transactions involving tokens can be subject to regulations, the tokens themselves do not constitute or automatically fall under the category of being a security. This distinction is crucial for ongoing debates about how crypto assets are going to be regulated. That's kind of interesting. Now, in a bit of oddball news, I don't know if it's oddball news, but it's, I guess, Trump news. Trump's sons unveil World Liberty. Make world liberty again. MWLA. Voila. A new era in finance is here. A new era. This is the new era. It's a whole new era. This is big stuff. Launch of World Liberty Financial. Eric Trump has officially launched World Liberty Financial, World WLFI, a decentralized finance project, DeFi, aimed at transforming the financial landscape by leveraging blockchain technology to offer services like lending. Oh, all right. Focus on financial inclusion. You know what this means, though? Even if all of this is stupid crap, at least Trump likes crypto. He's put money in his pocket. He sold shoes. He sold shirts. He sold hats. Trump liked crypto. Kamala don't like money, but Trump liked crypto. Anyway, WLFI Wolfie on Wall Street. Anyway, Wolfie WLFI seeks to empower users through smart contracts and decentralized protocols. Whoa, what a mind-blowing idea, Trump Jr. Facilitating peer-to-peer transactions and reducing reliance on intermediaries. Wow, these guys just must be like, oh my God, look what we could do. And everybody's like, people have been doing that for like 8 years, right? Yeah, no. Is that, yeah. Well, we're going to do it different. Why? Well, we're going to call it WLFI. Okay, yeah. I don't think anybody's called anything that yet. So this would be completely different. WLFI promises a user-friendly interface. All right. Robust security measures and a diverse range of financial products tailored for both individual and institutional investors, like lending. Lending. That's the thing, lending. So they officially launched it. It's a groundbreaking DeFi project, which was weird because how does DeFi break ground if it's electrons? Anyway, it's going to transform the financial landscape. I feel like this guy watched a nature video before he did this write-up. Anyway, the introduction of WLFI aims to leverage blockchain technology to provide a suite of financial services, including lending. So maybe they haven't expanded on this so much. Obviously, trading, investment stuff, all that kind of, all while promoting transparency and efficiency in contrast to traditional financial systems. Well, it's a good thing that Trump showed up because the rest of the crypto world wasn't really even moving forward. But now that Eric Trump, Donald's son is here, we can move. It's time to move forward, everyone. It's time to move forward with crypto. They have a commitment. WLFI is committed to enhancing the DeFi sector, which is great because I was worried about the lack of commitment in all the other projects, the thousands of other projects that lacked commitment. Well, that they probably do lack commitment. Anyway, the DeFi space has obviously seen a lot of growth recently, and with an increasing demand for alternative financial solutions, WLFI is positioned to capitalize on this trend by offering innovative features and prioritize security and accessibility. They want to facilitate peer-to-peer transactions, so like Bitcoin, right? Thereby reducing reliance on intermediaries and fostering greater financial inclusion. These are all good things. It's all bumper sticker stuff. I don't know. This is all full of bigness, but there's no actual news here. But anyway, cool. Robust security, user-friendly interface. Awesome. That'd be great. I would love a user-friendly interface on my crypto stuff. So thanks, Trump sons. I give you a Bravo Zulu on a job well done. Anybody else excited about Trump DeFi? Listen. Oh, did Trump have stakes? Oh, yeah. Let's talk about earnings. So the earnings were good. They beat by a fair amount. I don't know what their top line was, but what they didn't do is they didn't super beat earnings. They beat earnings, but they didn't super beat earnings. And I think that people expected them to super beat earnings. So, man. And so there was kind of a mild sell-off. And we saw this. Matter of fact, why don't we go take a look at markets while we're talking about it, because it's kind of apropos before we talk credit spreads. Let's go look at markets and let's look at what the AI coins did, which was what we said they were going to do yesterday, probably sell off. Okay, the Bitcoin is up. The Ethereum, the Ether is up. Everything's up a little bit. You know, it was kind of sloppy and kind of gummy the last couple of days. But again, things, melt back up, and they will continue to do so, which is why a little, dollar cost averaging really takes the stress out of all of this stuff. It really makes it where you can be just almost non-emotional about your investing, and save your emotions for movies with Meryl Streep and John Wick and Blair Witch, and that's where you spend your emotional, your emotional collateral. Where you don't spend it is in the crypto space or in any of your investments. If you can, that might be the most important skill: separation of your emotion and delayed gratification. If you can put off gratification, if you can suspend your need for instant gratification. One of the things that's also helped teach me that is when we order these cars for the shop, we get all excited about these cars. And it takes, most of these things that we order them a year to a year and a half in advance. Dear God, man, you get excited, and you read an article, and you see a news blurb, and you see some test drives, and you're like, oh man, this is going to be awesome. How much longer? Oh, 15 months. Shit. And then it's going to be, and even when it gets here, it's not here because it's got to go through customs. It's got to go through PDI. It's another 3 weeks. And even when you got it, you don't got it, because then when you have it, you got to take it and get it PPF'd. And then you got to go get a plate put on it. Then you got to get Apple tags put all over that damn thing and secret GPSs so that when someone tries to steal it, you can go snatch it back. You can go repo. Oh, man. But delayed gratification will carry you further. That skill will carry you really, really far. And I would urge everyone to try to develop it, even in your day-to-day stuff. Try to put things off for a few minutes to an hour that you want to do right now, unless it's fitness. Do that right now. If it's like well-being, do that right now. But if it's some gratification thing like, oh, I want to eat this snack or whatever, or put it off. Practice putting things off for a little bit. It's a good habit. Anyway, so what happened to the AI coins? They basically the bed. They sold off. There's not really any other AI coins. They say that Graph is an AI coin, but it's an Ethereum coin. Doesn't make any damn sense that it's AI. I don't follow Near, but Near sold off a little bit. Just kind of reading around. Filecoins kind of melting back up. The market's kind of just the reverse of yesterday. Things were down by a bit. Now they're up by a bit. Oh, for those of you that weren't sure, that didn't understand why Hypercycle was up in the mid 30s, somebody got fished. PFHISHED, fished, and got scammed out of about 100,000 tokens. And then the people that scammed them immediately went and sold them on the DEX, just dumped them. And that's what dumped the price down from like the mid 30s down to like 25 or 24 cents, just all of a sudden. And then it bounced back up. Anyway, that was weird. They're going through there's a lot going on behind the scenes at Hypercycle. I may know more tomorrow, but I think they are getting close to a series of press releases. They're going to change the names on some things to kind of make it easier to understand what's going on in the Hypercycle ecosystem as far as licenses and nodes and all this kind of stuff. So I think they're going to rename. They're going to change the naming conventions to make things easier on certain bits and pieces. I think the hypershare is going to get a different name that makes a little bit more sense about what it's trying to achieve. So anyway, I got a message about that. So that's going to be kind of fun. So it looks like they're getting ready to roll out, maybe to start rolling out for that big client. That's kind of cool. I don't think we're very far away from people, again, waiting for audits to come back on those token and node marriages, but I don't think we're very far away from people being able to start running AI software, AI algos, and things like that across their nodes, which means compute's probably not that far away. Anyway, that's all I know because it was a bit vague. The emails were a bit vague. The messages were a bit vague, but we have a meeting tomorrow morning where I will know a lot more. So yeah, cool. Everything else kind of quiet. Everything's just kind of 3 or 4%. It's just not in the crypto space. That doesn't mean much. It's cool. It's exciting. I guess it would be in any other market, but in crypto, it's just a Thursday, man. So there we go. Aptos is one I've had my eye on. I think I think people will pump it. I think it'll get pumped. I don't see any reason why it wouldn't take out its all-time highs in a bull market. It's a layer one. It's got a lot of spammy, scummy VCs involved. The same spammy, scummy VCs that were mostly kind of connected to Solana. So I can't imagine a world where they don't try to pump the crap out of this. And if you think about it, you've pumped Solana, you made a lot of money. But are you going to take Solana from $150 to $1,500? That's not likely. But could you take Aptos from $7 to say $70? More likely. So it's wash, rinse, and repeat with these VCs. You know how they work. You know how they operate. So keep that in the back of your mind. Again, not telling anybody to do anything. In full disclosure, I own, what is my percentage of Aptos? It's tiny. It's tiny, but I own it. Let's see. My position in Aptos is, I gotta look it up. I love this live coin watch. You can do some cool stuff with it. Anybody, if you start kind of playing with it, anyway, you go down to the bottom, you go all transactions, you can search by token, it'll bring you every transaction that's occurred with that token. I own, it's not much, almost 1% of my portfolio is Aptos. Almost. Are they almost? I mean, almost 1%. So this is not even, this is a half lottery ticket for me. But I thought about bringing it up to a full lottery ticket, which is 2%. So that's where I'm at. That's the most I would go on something like that. Again, not really advice, just kind of telling you where I'm at. I bought some Aptos. Nice. It's a layer one, man. Yeah, it was 0.9. 0.9. It's still, even though it's up, it's still 0.9 because everything's kind of up. Win Lambo before Halloween. We hope it's on a boat. So this is the way it works. They say that it's been through production. We got the word it went through production. It started building in July. It got done building. It was on a boat last Monday. So what? 10 days ago? No. I'm getting all that screwed up. It was on a boat Thursday, last Thursday. So 1 week ago, it was guaranteed to be on a boat. 15 to 21 days on the boat, 5 to 7 days customs clearance, probably 3 to 5 days PDI once it gets to the dealership. Then we get the car. Jeesh. So we're trying to arrange a long-term rental on it, so that right when we get it, right when it's clean, right when it's PPF'd. You know how cars need wrapped? Well, they wrap cars. You can wrap cars with a kind of clear coat that protects it from rocks and all that kind of stuff. And then you just, like, once every couple of years, you just pull that stuff off and have them reapply PPF. And we're actually building a PPF facility, like a small area at our facility, about as big as like 2 cars, where we can do PPFing, like coating and tinting and all that stuff right there at our shop. This is like, keep it in house. Anyway, we spend a lot of money on that PPF. Anyway, okay, enough of a diversion. It's not a ceramic coating. It's an actual, think of it just like a clear coat tape. Think of it as a clear wrap. And what you can also do is you can get the wrap. They make an opaque version of it that's kind of foggy, misty. And when you apply it, they also call it stealth wrap. It's a misty clear coat that makes the car look like a matte finish. So without doing matte wrapping uses vinyl, and doesn't always turn out so good. Sometimes it looks kind of crappy. You guys know, you see a wrap and you're like, it's kind of weird. But the stealth coat is a real clean way to just take the color and of the existing color of the car. And by the way, if you have a cool car, but you're kind of bored of it, and you get the car stealth broad so that it's changes color, like looks like the matte version, it's like you have a brand new car. It's awesome. No. They've come a long way. They've come a long way on the clear bra stuff. It's as good. I mean, it's as good as paint now. It's better than paint, because if part of the car gets popped, you just rewrap that little area. You don't have to go and paint and color match and all that kind of stuff, which is not so easy. Anyway, there's a little diversion into cars. All right. Today, we are going to talk about credit spreads. We had been beating around the bush about credit spreads. We said, and again, it's probably me and 3 other people here that care. It's like me and Kirill and Howard that care about, that even think that's interesting. And it's not super interesting, except that it's a huge piece of the macroeconomic lending markets, credit spreads. So I want you guys to know about it, because it is something that you will factor in. It's another gear in the complex watch that is macroeconomics. And if you pay attention to that, it's going to make decision making easier, because when you look at the financial system and you look at the macro information coming in, you'll hear bits of pieces of information coming from different places. You'll be able to weigh them correctly because you know what they are. But if someone's talking about credit spreads right now, most people will be like, I kind of get it, but credit spread, lending, stuffy thing. But we need to go into some details. Now, I had a cool piece of artwork. Let me see if I can get my cool piece of artwork. Oh yeah. It did an okay version of it. I actually had to cut out like some weird words that they haven't figured out words yet in AI artwork. Unfortunately, we're almost there, but not quite yet. Anyway, let's talk some credit spreads.
Hello. You're late.
You're bad at math, but I'm giving you an A+ in confidence.
Just doing what I gotta do.
Extra credit.
Okay. And real quick, let me make sure comments, I can see them. Ooh, I need to do royal blue satin for the BMW. That might be cool. Anyway, okay. I digress. Understanding credit spreads. Woo! Why does risk actually matter in lending? Have you ever lent something to a friend and wondered if they would return it? Have you ever given money to an uncle or a relative and wondered, is that money coming back? Is that just dead money? Oh, I have. Not to an uncle, because those guys are all pieces of crap. But I've given a lot of money away that ain't never coming back. It's always best among friends to just assume it's a gift. So if you think about it as a loan, that's going to change that relationship. You're going to find yourself being a banker real quick. Anyway, so have you ever lent something to anybody, and wondered, will it return? It doesn't matter if it's a car, a bike, a video game, money, a pencil, crypto, whatever. I lent a half Bitcoin to somebody about 4 years ago, and then they, of course, leveraged it, lost it, and never mention it again in conversation. Like, never comes up now. My half Bitcoin. Anyway, what if you thought there was a chance that they would not return it? Which I just assume they won't return it. But if you think that they're not going to return it, you would be a little bit worried, right? Yeah, you hardly hear from him. Yeah, you've already bailed him out. Once you bailed your friend out, he's never. Yeah, you're not interesting anymore. So it's this idea that when lending something, there's a little bit of disquietude. There's a little bit of uncertainty. There's always uncertainty, right? Like, if they were doing what was right, they probably wouldn't need a loan. So the concept in finance that we're going to kind of bear down on is credit spreads. And credit spreads is a lot like this weird uncomfortableness of, is that loan coming back? Is that money coming back? And that is about understanding the risk of lending money, and how in credit markets, because remember, the whole world is cash and credit availability, or the lack of credit availability, right? That's what turns the gears. Banks being the last line of defense, and kind of like the first and last. Not central banks, banks. So if you understand the risk of lending money and how lenders will go to very interesting places to protect themselves, then you'll kind of understand, okay, if a borrower might not pay, it's a gradient, right? There's degrees of might not pay back in this. And that's what we're going to kind of get into. That's the credit. Credit spreads are the degrees with which you think a lender or a borrower may or may not agree on whether the money's coming back. And those degrees, those become credit spreads. And you can learn a lot by looking at credit spreads once you kind of know what you're looking at, or at least directionally know what you're looking at. So think about risk, just risk specifically. So you have two friends. You have Alice and Bob. One of them, Alice, of course, is super responsible, always returns what they borrow on time, perfect condition, washes it, puts gas in it, right? Then there's Bob. Bob is a bit forgetful. Bob loses things. Bob doesn't always return things. And he scratches your car and doesn't tell you, and you have to discover it and then ask him about it, and then he remembers it. Alice is easy to lend to. Bob is difficult to lend to. Okay. So if Alice and Bob ask you to borrow your car, would you be more comfortable lending it to Alice or to Bob? And what if there was money involved? What if it was, hey, Alice, if you want to borrow my car, it's $10 a week. I don't know what car you would be $10 a week. Bob, it's $40. Son of a bitch. And you will tell me if you scratch it. You will tell me. There's different degrees of risk for Alice and Bob. Make sense? Right. So when banks or investors lend money, right, or the government debt, banks, private, corporate, they think about the risks kind of in almost in the exact same way, but instead of lending a car to Alice or Bob, they're lending money to people that they might use to buy a car or whatever, or start a business or go and increase their gambling habits, whatever. But they're lending money to people or entities, companies, sometimes even governments. And just like with us and Alice and Bob, lenders, professional lenders, banking institutions, and private investors, they prefer lending to those who are more likely to pay them back. And if not, they need to be paid for that. They need to be paid for that extra risk. Okay. So a credit spread is the difference in interest rates between two loans due to risk. The loan to Alice versus the loan to Bob, right? So let's talk about the credit spreads a little bit more. Well, actually, a lot bit more. Let's dig in. So you're a bank, okay? And you're considering lending money to two different people. Again, Alice, Bob. One is very reliable. Surprise, surprise. That is Alice. She has a great job. The other is Bob. Bob is not as stable. He works as a waiter at an okay restaurant. It's not the greatest. It's not Boulevard Steak, but it's also not McDonald's. Somewhere in the middle, closer to McDonald's. Anyway, Bob's income is not as stable. Bob has missed payments in the past. Bob is less reliable than Alice. So with Alice, you might offer the loan at 3%. We're going to give Alice a 3% interest rate loan because I am pretty sure, we are pretty sure as an organization that Alice is going to pay us back. Bob, on the other hand, is getting a 6% interest rate because there is a higher risk that Bob will not pay us back. So we have Alice at 3%. We have Bob at 6%. The difference between those interest rates, 3 and 6, is what we call the credit spread. This is the extra cost for taking on more risk. Does that make sense? So this is 6%, Bob minus the 3%. Alice, the credit spread is 3%. Yes, we nailed it. All right. Let's continue. So these are obviously simple examples, but if one loan has an interest rate of 3% and another loan has an interest rate of 6%, the credit spread is 3%. The extra 3% is what the lender charges for taking on the additional risk of dealing with Bob and the Bobs, the many unnamed, well, they would be named, the many Bobs. Bob plural, is it like fish? One Bob, many Bob? Or is it many Bobs? Perhaps we'll never know. So let's look at how this works in the real world. So when companies need money, they can issue bonds. Okay, you guys know this. So you have the government debt markets, right? Treasury markets, and those along the yield curve are bills, then notes, then bonds, right? Short term, medium term, long term. Bills at the short end, notes, bonds. B&B. Then you have the corporate world, and the corporate world, you have time maturities that are they're usually much shorter as far as their expirations or maturities. But they have different companies, different corporations. Their debt has different levels of risk, and that's where you get. There's a rating system for debt, which is AAA. Well, basically, it looks like this. It's like think of it as a tower, and you have AAA, then AA, then A, right? Because 3 A's is better than 1 A. Am I right? So 3 A's, 2 A's, 1 A, triple B. Everything below this is technically considered high yield or junk debt. So investment grade is triple B and up. Triple B, A, double A, triple A. Below trip B, so double B, B, triple C, and down. Now we're in junk debt. And essentially, junk debt is not investable for a lot of pension funds, things like that have to be in investment grade debt. Investment grade, that's triple B and higher. Anyway, that's a slight derivative to what we're doing. But again, you want to know how it kind of stacks up. So when companies or corporations need money, they issue something called bonds, the same kind, similar in nature to what the Treasury does. But think of these bonds as really more of IOUs of what the company is promising to pay back with interest. Okay. The government can always pay back because they have currency that they can spit off of a digital printer in real time, no matter what. A company, not so much. They don't have a printing machine unless they're Tether. And then they do have a printing machine, but Tether ain't selling debt, they print it. So bonds are these IOUs. The company's promising to pay you back or the investors with interest. So companies can also go bankrupt, which that's not good. A company run by Bob will most certainly go bankrupt. Bob or my grandmother. So they have to offer higher interest rates to attract lenders, right? And that's another thing that people don't understand is when you see rates going up, what does that mean? That means that people are not participating in those markets. And the rates go up to entice, the yield goes up to entice people to come and invest. Oh, you won't do it at 5? What about 6? What about 7? What about 8? Oh, now you're interested. And back they come. And then those yields tighten. That's not credit spreads. The relationship between a bond's price and yields is not the spread. Okay? That's the inverse proportionate relationship between bond prices and interest rates. The spread is looking at two sets of loans, two kinds of loans, two flavors, and looking at the difference between the interest rates charged on both of those. And that's where we're focused today. So governments, obviously they issue bonds. That's what we talk about all the time, the yield curve, right? Because governments are usually more stable. They can print. They are less likely, unless it's like Argentina or just about any country in Europe, they're less likely to go bankrupt. You can have events where you go into hyperinflation, but governments will print and pay their currency. I mean, you're not going to have a government cash default. They will always pay you back the cash. There is such thing as a sovereign debt default when no one will just take the currency at all, and they completely default on their debt, and it's unrepayable. These kinds of things happen around wartime usually. But anyway, so if a company bond offers 7% interest rate, and a government bond, which is assumed to be safer, offers 4% interest rate, the credit spread is, anyone? The company bond is 7%. The government bond is 4%. 3%, right? We're back to our 3%. So 3% credit spread. The company has to offer more to compensate for the extra risk of dealing with a company that can go bankrupt versus a government that will, even if they're having trouble, they're still going to pay you their printed currencies. You're going to get the currency back. It may be devalued to the toilet, but you'll get the currency back. So, that's a kind of, Kirill, you're right. That's a kind of carry trade. Just collecting the spread, right? You can do that. It's tricky. The carry trade that the Japanese involve themselves in is a little bit different in that, in other countries where they would basically borrow for free and then take those borrowed assets, convert them, and then go participate in other lending markets. So, but it's similar nature. It's similar in nature in the kind of, so a lot of times it was government debt to other government debt, like just guaranteed free money where you could just borrow for free from the Japanese and go to the repo market and end up in U.S. Treasuries. So like in other kind of like risk-free instruments. So that was the Japanese carry trade, which is, starting to go away. Anyway, so let's take a quick kind of imagining. You are a lender. You own a big bank. Okay. You have a lot of currency units. You have two options. You can lend money to a brand new tech crypto startup, or you can lend money to the government. Who do you think is riskier? Bob's new crypto union DeFi Trump extravaganza, or lend money to the U.S. government, right? Who would you charge a higher interest rate to? Which should be kind of obvious, right? So anything with Bob or my grandmother is a fail. So why would this matter to us just as individual participants? Credit spreads aren't just something that bankers care about, and they affect things that we will deal with in our future, like student loans, car loans, home loans, credit card debt, and the way that those lending rates wash around and get all kind of gross. Understanding credit spreads helps you see why different loans might have different interest rates. So kind of a different kind of credit profile, right? And it can help you make financial decisions that are a little bit smarter down the road. And also lets you just kind of understand what's going on when people are saying, credit spreads are widening, credit spreads are tightening. We're going to talk about that. Those two specific obvious cases, and why when you hear those little news blurbs, yeah, it is. It's Greenfield's right. It's arbitraging lending instruments. Now that's a kind of a trade. Simply knowing that there's credit spreads tightening or narrowing or widening, that's actually important data that you can use, even not for a specific trade, but just understanding the macro landscape. Typically, credit spreads measure the risk in lending, right? High risk means higher interest rates. Lower risk, lower interest rate. So understanding these spreads can help you kind of better understand what you're seeing around you. Does that make sense? So credit spreads measure the difference in interest rates between loans with different risk profiles. The higher the risk, the higher the interest rate. Bob loans, right? The lower the risk, the lower the interest rate. Alice loans. And so understanding these things makes us weigh the macro and weigh bits of disparate information in the macro environment better. Okay. Does that kind of make sense? So I want to narrow down just for a few minutes, and let's just talk really quick, widening versus narrowing, because this is what you hear. You hear these news blur, the widening and the credit spread, the credit spread narrowing. You're like, you need to be able to just kind of like, okay, I get it. And what is that? What should you take from that? So widening credit spreads. When credit spreads are widening, the difference between the interest rate on riskier loans like corporate bonds, Bob loans, and safer loans, the Alice loans, like government bonds, is increasing. So when they are widening, that means that the interest rates on risky loans are starting to run. Corporate bond rates, what companies have to offer you, is starting to get more and more and more because it's becoming riskier and riskier. Widening, and we talked about this even in regular markets when you look at spreads widening. Those are less liquid, more volatile, riskier markets, right? So this is the same thing. Yields go up to entice to entice lenders, right? Borrowers will offer more. So widening, bad. The implication is that usually widening credit spreads indicate that investors are becoming more concerned about the risks of lending to certain borrowers. For example, there is maybe economic uncertainty in a particular company, perhaps in the real estate, commercial real estate sector, and it is seen as more likely to default, which many of them are. So investors will demand higher interest rates to compensate for the increased amount of risk. Okay, and that risk can be all the way to complete bankruptcy. So that's going to create a widening credit spread scenario. So imagine that normally a corporate bond might pay you 5%, right? And a government bond is paying 2%. So if investors start to worry about the corporate bond's risk, right, the amount of risk in that corporate bond, they might demand 6% or 7%. Let's say they say, no, I'm not taking 6. I want 7% on this piece of shit bond because you guys are garbage. But I will take that 7%. Okay. The spread now between the corporate bond and the government bond has widened. It was 5% for the corporate, 2% for the government bond, 3% spread to a 5% spread because now we're at 7 and 2, right? And yes, widening credit spreads, bad, nervous. Kirill nailed it. Bad, nervous, uncomfortable, don't want to participate, need more money, move to the sidelines. And banks are the same. Banks are lenders. Banks are participating. So you're getting this feedback. If you simply know that credit spreads are widening, it means there is uncertainty and disquietude in the market. What if they are narrowing? What if they're tightening? When credit spreads are narrowing or tightening, the difference between the interest rates on riskier loans and safer loans are decreasing, and they're approaching each other. Okay? And the implication for that is that this tends to signal that investors are feeling more confident about the risk of lending to certain borrowers, right? They're more confident in lending. It suggests that the perceived risk of default is lower. So investors are willing to accept lower interest rates on riskier loans. You're willing to accept less money from Alice because she'll pay you back. You're not willing to accept less money from Bob because it's unlikely he will pay you back, right? So in this same scenario, if the corporate bond rates drop from 5% to 4%, while the government bond rate stays at 2%, then the spread narrows from 3%, which was the original 5 and the 2, to 2%, which is the now 4 and the 2. And this indicates that investors are overall on that corporate bond feeling like that credit profile is less risky. Does that make sense? So why do you care? Widening spreads tend to indicate economic trouble or uncertainty, right? Uncertainty means volatility. And as investors demand higher compensation for taking risk, this is the reciprocal of that, right? This is what you see. Narrowing spreads suggest economic stability or optimism, as investors are more comfortable with lower returns on riskier investments. Okay. And so the impact for borrowers essentially is that for companies that are borrowers, widening spreads make borrowing more expensive. They make it more difficult. And they have to offer higher interest rates to attract investors. Narrowing spreads make borrowing cheaper because companies don't need to offer as high an interest rate to secure funding. So if you understand whether credit spreads are widening or narrowing, it gives you an instant insight into the overall market sentiment and the perceived risk associated with different borrowers and different investments. Bam! Credit spreads, bro. Hopefully that makes sense. So now when you hear these a-holes trying to big dick it on CNBC, the credit spreads are widening. You know what that means. Now, could they just say, hey, there's unrest, there's discomfort, there's disquietude, lenders are worried? Yeah, they could, but they're CNBC. They have to put everything into 17 words that could be put into 3 words. So there you go. We now know about credit spreads. Woo woo. Cool. And Kirill, thanks for poking me a few times on that one, because it is these kinds of macro tidbits. Again, for the few of us that are into the macro, it's cool, it's good, but you still need to be aware of these kinds of things. It just makes it easier to navigate and to do your game theory on the overall macro picture, right? It's another big gear in the watch that makes it easier for you to understand what's going on. Cool. All right. We'll see you tomorrow. I'm assuming Brandon will be same bat time, same bat channel. But if not, I'll be here for you to drop some F-bombs. You know I will. Oh, yeah. Stay in school. Don't do drugs. Don't do things my poor insolvent drunk, strung on meth grandmother, who is also a grifter, or Brandon would not do. And I don't think we dropped a single F-bomb this whole show. Is anybody on F-bomb watch? I think we did an F-bomb free Thursday. Now, we thought about doing tomorrow is the last day of August, because this is when we left Monday Morning Live last year. We thought we would do an FU Friday, our ode to Monday Morning Live. Thank you, Howard. Thank you for putting a bullet on that. We'll see you guys tomorrow. It might just be FU Friday.